Welcome to the Red Chair. Today we have Brian Caulfield. Brian, great to see you.
Nice to meet you again,
Good
Stefan.
to see you again here in Lisbon. You are a former managing partner at Molten Ventures, currently a venture partner and also chair of Scale Ireland. You have seen so much throughout your career. So let's start at the beginning. How did it all start? Where are you from? What did you study?
I guess it all started in Ireland. I grew up
Judging
in
by your
Ireland. Yes, that gives it away. So I grew up in Ireland. I went to college in Trinity College, Dublin, which,
Beautiful.
yeah, so many people know it, right in the middle of the city, and some beautiful old buildings. I studied engineering, and the engineering degree in Trinity was slightly unusual because the first 2 years everybody does the same thing. So
Like
you
in Portugal.
didn't really.
Yeah.
Oh, that's interesting. So you didn't have to pick a specialization. But I probably always knew that I would end up in computer engineering. So graduated from computer engineering in 1986. I probably shouldn't even tell you that, but there you go.
1986. And then what did you do?
So I did a couple of years postgraduate research working on a European Union funded research project, and then joined a small subsidiary of a Swiss multinational in Ireland, which was actually using a very early version of AI technology, Expert Systems, as it was known
in the late 80s.
Those days. Yeah, late 80s, about 1988. And I had that real job. I say that's the only real job I've ever had. I did that for a couple of years and then started my first business.
And what was that?
That was a company called Peregrine Systems, and it was software for processing disputed credit and debit card transactions, which at the time was a huge problem in the industry. Like, just the processing of each dispute typically cost about $50. And it was a growing problem, which is always nice. So it was a good market opportunity.
And what happened then? You sold the company, or how did it go?
So we went through all of the .com craziness. We ended up being one of the first very small Irish software companies to raise venture capital.
Uh-huh.
So we raised VC in 1994.
In Ireland?
In Ireland, yes. We raised the enormous sum of about 300,000 Irish pounds.
That was huge at the time.
Which today would be maybe 350,000 euros. So a very small angel round. But at the time, it was a big deal. Went through all the .com craziness. You know, to be honest, I could talk for an hour about that, but we were actually supposed to merge with a US company called Paylinks, and Lehman Brothers were scheduled to take us public on the NASDAQ in May 2000.
Wow, that was right before the whole thing collapsed.
Exactly. It was terrible timing. In fact, the first big blip in the market was March of 2000.
Yes.
And
I was in London at that time. Yes.
Oh, really?
Yes. I remember that very well.
It was interesting. Paylinks got nervous and they sold themselves to a company called CyberSource, who are already public. We knew we either needed to raise more capital, which was getting difficult, or sell the company, find a home for the company. And we ended up selling it to Trintech, who were also public on the NASDAQ market. So we sold it to Trintech in November of 2000. And I remember when we originally did the deal, Trintec's share price had already dropped from $75 to about $22. At Christmas that year, I sold a chunk of stock at $10.50 a share. And I remember saying to my wife, it couldn't go any lower.
But it did.
And by the time the next stock came out of the lockup, it was 60 cents a share.
Oh my God, yes. So those were difficult days.
They were crazy days.
They were crazy
but
days.
hey, easy come, easy go,
That's right. And so what happened after that? When did you get into VC? How did that happen?
So first, I became co-founder of two other startups. One, I had been, I guess, kind of incubating at the first business. And we carved it out of the first business, and I was lucky to find a great co-founder there, a guy called Gary Moroney. And I was tied in to Trintec for a couple of years, so I needed a co-founder for that business. I would say in some respects one of the luckiest days of my life, the day I met Gary, because he was a great co-founder. So he ran that business day to day that was called Similarity Systems. And we ultimately sold that to Informatica, which was a big US quoted data business. The other business that I co-founded at the time was called Prediction Dynamics. It was a very early machine learning technology business, which was focused on predicting price movements of various asset classes. It was probably a bit early for that technology in 2001, and we also got the go-to-market strategy badly wrong, and that business failed and had to be put out of its misery in 2004.
Right. You can't be too ahead of your own time, right?
Yeah, absolutely. I think when you talk to VCs, and I don't know if this is your experience about, their big mistakes, I think the mistakes boil down to really two categories. The first is people mistakes.
Yeah, that's the big one.
That's the big one, absolutely. And the second, I think, is timing mistakes, where we were either too late and there's a big competitor that's raised a lot of money and, or too early.
And it's going to take forever for this to actually become a business.
Yeah, exactly.
There's also the mistake where you just don't time the market correctly, right? Because there's a cycle and whatever, and you get hit by the cycle.
Absolutely. And actually the second business, the Similarity Systems, which was acquired by Informatica, at the time that we sold that business, it was a data quality management business. And the perception was that kind of data quality is part of data integration. And if you didn't sell then, maybe the future is not great. Personally, I believe that there's still a place for standalone data quality, but, at the time, that wasn't the market view,
Yes, you can't defeat the market.
No.
And so what happened after that?
So then in 2002, kind of on a part-time basis, initially I joined Trinity Venture Capital, which at the time was the largest tech fund in Ireland. It was a €160 million tech fund, which was a big fund at the time. And that was focused pretty much entirely on the Irish market, but north and south. So the whole island of Ireland, if you like. In retrospect, I think the focus on Ireland exclusively was a mistake. We'd have been
too much
better.
Concentration.
Too much concentration, both, if you like, in terms of a single economy, essentially. But also at the time, could you profitably deploy 160 million in the Irish market? I'd say perhaps it was questionable.
But this happens quite often, right? Particularly when there's public money involved. I'm not sure if this was the case or not, but there's quite often a push to do, put some money into a specific market within a specific time frame.
Yes.
And of course, things go wrong to a certain extent, right?
Yeah, absolutely. And at the time, it was a reasonably competitive market. There was no other tech fund quite the same scale as us, but, you had Act Venture Capital, Delta Partners, who else? There were 3 or 4 other funds in the market, so it was competitive.
Right. And which year was this?
So I joined initially in 2002 and was full-time from the start of 2003.
Right. And so then you left, and what was the next step?
So, I left Trinity, actually, as it turned out, ironically, but they changed strategy. They actually went public on the Irish stock market, but with a view to becoming more of a kind of a holding company with 4 large holdings rather than a venture capital investor. And the first deal that they did post-IPO in 2007 was to buy a chain of 11 hotels. And I'm a tech guy. I'm a tech guy through and through, and I just wasn't really interested in that. So I decided to leave Trinity Venture Capital, then was asked to go in as interim CEO by one of our portfolio companies, where sadly the CEO had died very suddenly. So that was a company based in Belfast called Epona, which was ultimately acquired by Intel. So I ran Epona for about 8 months. I knew that I wasn't the right person to run that business in the long term, but equally I knew that I needed to give the board time to find a permanent replacement. Right. So I stayed for about 8 months until we found a long-term replacement for the CEO role. And then went off to kind of do the grand plan, which was to raise my own fund.
Right.
By this stage, we're well into 2008.
Oh my God!
And things are looking pretty dicey. So as you can see, I've got a gift for timing.
Yes, I've done similar things. things.
So we tried, but we were not able to raise a fund. And, to be honest, it became apparent kind of pretty quickly that it was going to be very, very difficult. So I ended up in 2009 joining what was then Draper Esprit
in London.
And essentially joining them on the basis that, if we could raise capital in the Irish market, there was a seat for me at the table.
Right.
If we didn't, well, bye-bye, Brian. So we were...
And at the time, Draper was owned by the US Draper, or
it wasn't owned by Draper Fisher Jurvetson, but had a very close tie-up with Draper Fisher Jurvetson. So
you could use the brand, and
we could use the brand. We had a certain amount of kind of support from them on deals. The theory was, I don't know if we ever actually did a co-investment with them.
But that was the idea.
That was the idea.
You'd be the European arm of...
Exactly. And essentially what Tim Draper, at a time where a lot of VC funds were starting to expand internationally, so you had Accel opened an office in London, Benchmark opened an office in London. Tim's strategy was different. He decided that rather than opening an office, what he would do was kind of partner in what he perceived as being kind of best of breed investors in other geographies. So that was us. So we raised 50 million in the Irish market. About a third of that went into DFJ 10 in California and 2/3 into our European fund.
You did well.
So I held up my side of the bargain and, became a full partner with Draper Esprit. Over the years, I ended up as one of 3 senior partners and ended up being managing partner. And we IPO'd that business in June of 2016. We actually did our IPO 8 days before the Brexit vote. So for once, I got the timing right, because if we'd been delayed by 10 more days, we're in trouble again.
And then you got a good, that was a good bull market for a few years. But when you started Draper Esprit, how big was the fund?
So Draper Esprit 3 was a €100 million fund initially, but we also had a kind of a sideline because we had done a very large secondary transaction and acquired 3i's venture portfolio. Right. So it was a much bigger firm than a 100 million fund might suggest, And then when we did the IPO, initially the market cap was only about €150 million, and at its peak hit about 1.6 billion sterling, actually, so not far off €2 billion.
But when you started, it was much smaller, and where were you investing at the time?
So at the time, I suppose Draper Esprit and subsequently Molten Ventures has always been a pan-European investor. I would say just because of geography, a lot of the focus did tend to be on the Irish and UK markets, because that's kind of where the people were. We subsequently did a tie-up with a German fund that also had a significant presence in Eastern Europe. So, by that stage, we were probably really, truly pan-European,
Of course. And so what you've done subsequently was quite unusual for a VC, right? Number one, you became also a fund of funds in a way, right? You're investing in funds like us, and we're very grateful for that. And then also you went public, which is also not normal. So tell us a little bit about those two. Why did you decide to do those two things?
So I suppose there were a couple of reasons for going public. I think the first, if you like, the kind of the selfish reason was Europe is a very difficult environment in which to raise a venture capital fund. A lot of the big players from an LP perspective that exist in the US market, the big public pension funds, the big university endowments, don't really exist in the European market. So it's tough. So we felt that it would give us much better access to capital, and that largely turned out to be true. We found it a lot easier to raise top-up capital. The other thing that we'd seen is that from the perspective of founders, it's often the case that a company that might have a 13-year journey to get to an exit, that doesn't necessarily fit well in a 10-year venture capital fund. And also with the 10-year venture capital fund, you typically have restrictions around how much capital can go into a single investment, regardless of how good and interesting the team are. So we felt we could eliminate a lot of those restrictions, which we did. And another restriction that we eliminated was most venture capital funds can't invest in other funds.
Right.
Whereas we were enabled to do that. And we felt that that was a great opportunity because we were primarily kind of Series A and beyond. We wanted to
access to the earlier stage.
Access, exactly.
And pan-European earlier.
Exactly. So, for example, investments like with Indico gave us access to earlier stage deal flow where we were getting a little bit of insight into the progress of the companies earlier on. And we had, if you like, a trusted partner within, in those investors. So it gave us kind of more geographic coverage, and then sometimes also sectoral coverage, where you might have a firm that's very focused on a particular niche that maybe we didn't know that well, but they knew. And, we knew that if they had been invested in a company for 2 years in this space and it was going well, then you know what, it's the real deal.
You're definitely pioneers in this new way of investing in VC through funds and through and being a public company with more patient capital and also providing liquidity to your investors in the company that is public, right? Which is also another big problem for the LPs in VC and private equity in general.
Yeah.
Why is it that other firms have not done this? I mean, you've had that in private equity in the US particularly.
Yes.
The big ones, right? The multi-assets managers, multi-stage, multi-types of investments, but not really in sort of like VCs in Europe. Why do you think is that?
Yeah, so I think there are a couple of reasons for that. The first thing is that public market investors don't want to invest in a blind pool. They're not just going to give you a couple of €100 million and say, go off and make some investments. They want an existing portfolio of assets that they can look at and kind of value, essentially. So that obviously makes it that makes it pretty difficult, because you need to have a portfolio of assets that you're going to the market with. And we were, I suppose, lucky in some respects that we had some LPs who were very supportive of the strategy and who were prepared to roll their stakes in the fund into the public company. And we had others that didn't really want to do that or couldn't do it, who needed to be exited at the time of the IPO. And, to be honest, if some of those had wanted to block us from doing the IPO, they probably could have done. So it's hard to do. And I think, even though the Molten share price is not where we'd like it to be right now, I do believe in the model, and I think in the European context, it is something that we should be.
Because the problems that you mentioned are still there, right? It's extremely difficult to fundraise.
It really is.
Liquidity is an issue. Exits are an issue, particularly if you've constrained it to 10 years.
Yeah.
Because quite often successful companies even take a long time to become very successful, right?
Yeah.
And to deliver the returns. So, from your perspective, what are the things that Europe, or say UK, Ireland, Europe, could do to overcome and to sort of fulfill the promise of European VC, which apparently we have better returns than the US counterparts, but we still don't have the money anyway, right? So
I mean, it to be honest, it's unfortunately quite shocking. If you look at it from a per capita perspective, the amount of capital invested in the US is typically about 5 times what's invested in Europe. So our companies, frankly, are under underfunded, and that's a big competitive disadvantage. The other issue which is related to that is the velocity of capital. So, for example, if you have a very early stage company where there are two founders, and you've got an idea, what should those founders be doing? They should be doing customer discovery.
Yep.
They should be building product. That's what they should be spending their time on.
Not fundraising all the time.
Yeah. So if it takes 6 months for them to raise a small pre-seed round, that's incredibly damaging and distracting. I'm encouraged that I think there's more realization of the problem in Europe at a political level now. And, I had the pleasure of meeting the Portuguese European Commissioner relatively recently, who is responsible for the capital markets and capital markets union. Firstly, I was impressed that there was a really clear understanding of some of the problems.
Because these are very technical issues, by the way. It's not easy for everybody to just understand what the problem is.
Exactly, yes.
She does.
She does. Very, very impressive. And unfortunately, the downside is that for the European Commission in this area, there is not much that they can do to make governments act. But what she has done, for example, is make a recommendation that every country should have some form of tax-incented investment vehicle for the man in the street, so to speak, And, to give you an indication, in Q2 of this year, and I know the Irish numbers very well, so apologies for quoting Irish numbers, but in Q2 of this year, there was 113 million invested in venture capital in Ireland.
By individuals or institutions?
But mostly institutions, but that does also track angel investments where we're able to get, information on the size of the round. So that was the worst quarter in 10 years, right? So really quite depressing. At the same time, there is 163 billion euros in low interest deposit accounts in Irish banks, and there's a
waste of money, basically.
It really is. It really is. Your money is losing value over time
because of this perception of risk.
Because of the perception of risk, yeah, and because there aren't vehicles to enable individuals to...
There's no incentive, really.
No incentive.
But I think the European Commission is trying to deal with that.
They absolutely are,
Hopefully something will happen. Brian, it was wonderful to see you here in Lisbon.
Great to see you again, Stefan.
And I hope you have fun at your house here in playing golf in Óbidos.
I'm really enjoying it, and I'm delighted. I'm delighted to be doing this, partly because my experience of the Portuguese people has just been so great. I think the Irish and the Portuguese are very compatible.
That's right. We have a lot in common. Every time I went to Ireland, we've had a great time also.
Yeah.
Wonderful.
Thank you.
Hope you had a good time and enjoyed this episode of The Red Chair.